about 30 seconds out. And Steve, go ahead.
Well, good afternoon and welcome to this special webinar from the Metropolitan Milwaukee Association of Commerce. I am Steve Boss. I'm the Senior Vice President for Government Affairs and Public Policy here at the MMAC, and we are so glad you can join us this afternoon for what I am confident will be an interesting and informative discussion that hopefully will be good news for your business. As you probably know, if you're tuning into this webinar right before Christmas, Congress gave us a little stocking stuffer in terms of yet another COVID relief package, another comprehensive bill of provisions to help business and communities deal with the economic fallout of the COVID pandemic. While that was welcome relief, it also triggered a flurry of questions. I know at MMAC and at our member companies, we kept hearing a lot of these about what the provisions in the bill actually mean in a real nuts and bolts way to businesses and to our members and to the bottom line of these companies. And so I'm really pleased that we were able to reach out to Sarah Helton and Vince Maroney with Michael Best Strategies. They're some of the foremost experts in these areas, both in the finance and SBA area and also in the just straight legislative policy areas. And they're with us today to give us a somewhat comprehensive breakdown of what was in the relief package for businesses and other entities, and also how you might want to consider moving forward and accessing the relief that's available to you in the COVID package. So there's a long way to go and a relatively short time to get there. So I'm not going to use up a lot of time with the wind up here. There's a lot of content in this bill. I did want to mention to all of you who are viewing and participating in this live that you can put any questions you have as we go through the presentation in the Q&A function, and we will get to those after Sarah and Vince go through their presentation. So without further ado, Vince, Sarah, thanks so much for being willing to join us today and lend your expertise as a resource to our MMAC members and guests. And I will turn it over to you. And I'm going to do the COVID motto of Sarah.
Yep.
You.
Yep. Thank you. As that's been so much of what we faced, throughout COVID-19. No, but thank you, Steve, and thank you to MMAC and your members for providing Vince and I the opportunity to share a bit with you today about what's in the latest relief package. We know that there's been a lot of questions that came out of the CARES Act, a lot of questions that are coming out of this fourth relief package. And by no surprise, it's a 5,000 page bill that was combined with the omnibus and some other provisions too. So what we'll do today is we intend to provide you a snapshot of what's included in the bill and some highlights that are in particular are related to the small business provisions, including the second round of PPP that's going to be available, some of the tax provisions, a snapshot at the direct economic relief, and then highlights of some others. But if there's anything that we don't touch base on today, please don't hesitate to reach out to Vince or I. Next slide. And next slide. So as Steve had shared right before the holidays, Congress had passed what is the fourth round of COVID relief. This bill had been in the making since CARES Act was last passed. So several months of negotiations that had gone on between the Democrats and Republicans and the administration, understanding that businesses and industries were at no better place necessarily as far as from when they were as when COVID had started. And so with that, there was the House Democrats had proposed a $3 trillion bill. Senate Republicans have proposed anywhere between $500 billion to $1 trillion bill. And finally, in December, we had come to some negotiations at a $900 billion mark. And President Trump signed that into law on December 27th. With that, as I mentioned, there's relief provided and they're related to small business provisions and the PPP. There's funding for vaccine distributions, understanding a key focus of this administration and the incoming administration under President-elect Biden. There's agricultural funding, transportation, rental assistance, food assistance, tax breaks that will cover in part funding for education and childcare. But there are things that were not included and that were heavy part of the discussion leading up until this final bill. And some of those key provisions that we know were of chief interest to the business community in large part were, for instance, the COVID-19 liability protections for businesses. This was a key priority for Majority Leader McConnell, understanding the concerns that the business community has, especially for those that are looking to remain open, that have were in line with any regulations or guidance as far as providing safety for your employees and for your customers, what that may mean not to be subject to frivolous lawsuits. So that was the focus of the liability protections. From the Democrat priority, they were working on additional state and local funding. There was a large amount of funding that was provided under the CARES Act with additional push for this fourth relief to see funding included in there as well. That was not included in this fourth bill. And then the last thing that I wanted to highlight that wasn't included is, as you all may recall, under the CARES Act, there was some facilities that were stood up intended for more long-term relief for small and medium-sized businesses through the Main Street Lending Program. Unfortunately, for most businesses, that program was a failure due to the terms that weren't advantageous for lenders or for borrowers. And so as that facility has come to an end, no substitutable facility as far as long-term relief has been provided. There was some discussion of it. So we'll see in future relief bills that may come in early 21 if we'll see some long-term relief in addition to the immediate relief that we see under the PPP. So now let's dive into the exciting parts of the bill first off with the PPP. Next slide. And you can go ahead to the next slide as well.
Yep.
And Vince, let me turn it over to you to provide a snapshot about the second round.
Sure. Thanks, Sarah. So, over $284 billion was appropriated or allocated to this new round of PPP loans, with some dedicated set-asides for very small businesses, which we'll touch on a little later. But it's essentially somewhat of an extension of the first PPP and also a second draw for those who have already received PPP loans, with new eligibility and different other requirements that we'll go through here. The key, as was the key the last time with the original round of PPP loans, is that the SBA is supposed to release guidance within 10 days after President Trump signed the bill, which is actually today is the supposed deadline. As of 15 minutes ago, before getting on this Zoom call, nothing had been released yet. So we're still waiting on that. And as that happened, as we saw last time, there was some clarity with this guidance. There were new rules implemented with this guidance. There was additional confusion that came about with some of the guidance last time. So hopefully it's not as much to untangle as last time. There are some new additional nuances that will need to be clarified, which we'll walk through. But this is going to be key, and it's something we're really still waiting on. So, a lot of the stuff we say today, or, different takes we have, may turn out to be a little bit different based on the guidance or additional regulations that are issued, which should be very soon. So one of the key distinctions from the original PPP loans is the eligibility requirements. It was the 500 employees with different alternative size tests that small businesses or different entities could use to obtain a PPP loan. Now it's no more than 300 employees, and an additional requirement that you need to demonstrate that at least you've had at least a 25% reduction in gross revenues or receipts between comparable quarters in 2019 and 2020. So a bit to untangle there. Seems straightforward, but is it, whether or not it's really that straightforward is still up for debate. Whether or not the alternative size test, the employee or revenue-based tests apply, or the net worth test is still kind of out there. It's not clear from the legislation whether or not that'll be the case again. But in the original round, several businesses used alternative tests to qualify or become eligible for these PPP loans, and that it's not clear whether or not that'll be the case for this second round. Also, what'll be included in gross receipts, how to determine that. I assume there's going to be some additional clarification or guidance on that point. We just don't know enough yet. It essentially just says gross receipts in the act. So at this point, we're just speculating. A couple other key points: if you're a second-time returning PPP borrower, the first round of PPP funds must have been used or will have been used by the time you get your second draw, which is key because it doesn't mean you have to have had it forgiven or even really applied for forgiveness. Just show that you've used it or will use it by that time, the full loan amount. The eligibility also, churches and religious orgs, that was affirmed in this legislation, and prohibits future administration from making them ineligible. It expands PPP eligibility for certain 501c6 nonprofits and destination marketing orgs with 300 or fewer employees that do not receive more than 15% of their revenue from lobbying. So this is an additional eligible entity category. And it also importantly excludes publicly traded companies from PPP eligibility, which was not clear or the case last time. We can go to the next slide. So this is more in the meat of it. The second draw loans, the maximum loan size is different from the first time around. It's a max of either 2 million or the greater of 2 million or 2.5 times your average monthly payroll costs. So the 2.5 times is the same as last time, but there was a $10 million cap. Obviously in this second round or for these second draws or even for first time PPP borrowers, this cap will be less than the original PPP loans. But there is a carve out or an additional exemption for small businesses with the NAICS code 72, which is accommodation food services. So restaurants, hotels, different businesses in that sector, they can receive essentially larger PPP loans potentially. If they're under that $2 million cap, it could be up to 3.5 times the average monthly payroll costs to help them combat different restrictions that have been in place, not being able to have full capacity or maybe not being able to have any in-person or in restaurant dining, anything like that. Maybe they're just doing carry out. So that's kind of the goal there. The 60/40 requirement still remains, as well as the affiliation rules. So the 60/40 requirement, borrowers still have to spend at least 60% of their PPP second draw loan, or if they're a first-time borrower, their loan on payroll costs, and then 40% on the other qualified or eligible expenses, which we'll touch on, which have been expanded a bit in this round. But the affiliation rules, like the original PPP loans, still apply. You still have to weave through them, and they're still subject to these new eligibility requirements. And it'll be a similar analysis, basically the same analysis as last time. And these also apply to the nonprofits. So assuming that guidance from before will also apply to these, and you'll have to run through that same analysis to determine eligibility. And then as mentioned on the last slide or initially, there are specific set-asides for just what most people would consider, honestly, small businesses with 10 or fewer employees, to make sure that they get the funds that they need this time around. So there have been specific set-asides for these businesses with 10 or fewer employees, as well as a couple other categories, but that's probably the biggest highlight. I think we can go to the next slide. And now some other general PPP improvements in this act. First, it allows the borrowers who returned all or part of their PPP loan to reapply for maximum amount applicable, and allows lenders to recalculate borrowers' loan amounts due to changes in the regulations. So it essentially gives them a second chance at this, even if they weren't maybe eligible last time, but potentially are eligible this time. It defines seasonal employer, and that definition is essentially and last time around, it wasn't clear what a seasonal employer was. So there was a lot left to interpretation, but essentially includes anyone who operates from no more than 7 months or in a year, or who earned no more than 1/3 of its receipts in any 6 months in the prior calendar year, which is helpful. It also provides needed assurances to PPP lenders that no enforcement action could be taken against the lender who originated the loan in good faith, complied with all regulations and relied in good faith on a borrower certification and documentation, which is important for these lenders. They're processing a lot of loans, doing a lot on their end. If they're doing things in good faith the way they should be and going through the due diligence, then this is an important aspect for them. The act allows PPP borrowers to include additional group insurance payments when calculating their PPP payroll costs. This would cover insurance plans such as vision, dental, disability, and life insurance. And this would help borrowers get, an additional loan amount that perhaps they otherwise wouldn't have last time, just, in an increment greater than what they otherwise their payroll costs would have been. So it helps expand that universe of costs. And lastly, the act establishes a procedure in the bankruptcy process if the SBA determines certain small business debtors are eligible for PPP loans. There's it needs court approval and things like that. So anyone in bankruptcy, any companies in bankruptcy can still obtain these loans, but there are specific processes they need to follow and approvals they need to obtain prior to doing so and prior to the lender making these loans. These aren't all the improvements in the act, but these are just some of the highlights that we thought were interesting or applicable for, several businesses. We can go to the next slide. I think I'll turn this over to Sarah to talk through the loan forgiveness, which is probably also very important or interesting for most people on the call.
And we've gotten a lot of questions from companies related to the forgiveness process too, as you work with your lenders through that. So SBA had initially released information about the loan forgiveness process last summer, but they didn't begin approving loan applications really until September of last year. And many of you may have found too that your lenders weren't proceeding through the forgiveness process, just understanding that they expected some changes to the forgiveness process in this fourth package of relief. So now that we have some finalization to all of it, hopefully we'll see some expedited approvals made. With that, just this overview of the process itself and the timeline of what to expect, and then we'll look at some of the changes that were included in this fourth package. So first off, to apply for forgiveness, work with your lender that you received the PPP loan from. If you receive a PPP loan of less than $50,000, there'll be a streamlined process and forms to fill out. Also, with this fourth package relief, that also includes loans under $150,000 too, where there's streamlined processes for forgiveness. But be prepared to provide significant documentation, including information about your payroll, your mortgage interest payments, payments for rent or lease, as well as to payments for your utilities. So anything, all those expenses that are considered those forgivable expenses, you'll have to provide documentation for. So when can you actually apply for forgiveness? Well, go ahead and submit for forgiveness at once all of your proceeds have been used for which you want to apply for forgiveness. You have up until the date of a maturity of your loan, so whether that's 2 years or 5 years. However, note that if you don't apply for forgiveness within 10 months after the last date of the covered period, then you're going to have to start making payments, even if we're not to the date of your maturity. So With that, as far as the timeline is concerned, once you provide documentation to your lender, they have about 60 days to review it and then submit it to the SBA. Once the SBA has it and goes through all the documentation, they have about 90 days to review and issue a decision then. So what this is ultimately saying is it could take up to 5 months based on the deadlines that are in place. But SBA has said that they're going to be moving through applications pretty quickly for any loans that are under $2 million. To date, there's been about 595,000 of forgiveness applications that SBA has received from lenders. They've gone through and processed about 367,000 of those, and that was from data back in November. So you can see they are moving through them that they have received. As I mentioned, though, for loans that are above 2 million, there's going to be some lengthier timeframes required to process your forgiveness applications. Included too that some of you may have received what's called a necessity questionnaire that really is part of the audit process that they were going through for the loans over $2 million. So be prepared for some extra time and scrutiny for any loans over 2 million. Next slide. Now, looking at the improvements and changes that were made to the loan forgiveness process in the fourth round of relief. One is understanding that there's an expansion of what is considered forgivable expenses. So under the CARES Act, forgivable expenses included payroll, mortgage, rent, utilities. Well, now that's expanded to include supplier costs. So anything related to existing contracts or purchase orders. Also, too, we understand a lot of businesses have incurred pretty substantial costs related to PPE or other adaptive costs. And so those are now covered, as well as to some technology operation expenditures. And we'll receive, as Vince had mentioned, there's additional guidance coming out. And so these will be spoken to in the guidance as well. As far as borrower flexibility, it allows you to select a loan forgiveness covered period between 8 and 24 weeks. If you also went through and received a disaster loan advance, that $10,000, as well as a PPP, that disaster loan advance was actually taken out, subtracted from your PPP forgiveness. Well, now that eliminates that requirement. So that's $10,000 back. And then also, as I had mentioned, for any loans under $150,000, there's streamlined processes that will now be put in place for the forgiveness application. Next slide. So in addition to the PPP, there are other provisions that have been included that will benefit small businesses, including under the EIDL, a new grant that's going to be stood up for some shuttered venue operators. And then Vince is going to speak to some of the relief measures that have been provided under the existing SBA programs of 7A, 504, and Microloan. But first, let's start off with EIDL. Under the fourth package of relief, it extended the covered period for EIDL grants through December 2021. And then also there's been additional targeted dollars for EIDL advances for low-income communities. Secondly, there's a new grant that's being stood up for shuttered venue operators. And that's essentially a $15 billion grant with that would be provided to live venues, independent movie theaters, zoos, cultural institutions like museums. Understanding a lot of these have been essentially shut down over the past year. And so you would not be eligible for both a PPP and this grant. So understand where there's going to be most benefit to you as far as receiving the most dollars there. But you may be able to receive up to $10 million in the initial grant, and then an additional supplemental grant that would be at a rate of 50% of that initial grant too. You must be able to demonstrate about 25% reduction in revenues, and understand there's going to be priorities for those venues that can demonstrate a 90% hit to their revenue, and then a second wave for those that are able to demonstrate a 70% hit to your revenue, and then we'll open up to all other operators as well. But the grants cover expenditures like payroll costs, rents, utilities, PPE, very similar to those costs that are available to be covered as forgivable expenses under the PPP. Next slide, and Vince, I'll turn it over to you.
Sure. So a little bit on the existing SBA programs, I guess some of the programs that existed prior to the PPP, that companies may have existing loans or maybe thinking about getting a loan under one of these programs as opposed to, or in addition to, a PPP loan. So just as a bit of background, and then I'll talk through some of the, I guess, the main enhancement or the main modification of these programs in the form of the debt relief. But the 7A program is really what the SBA considers probably its flagship loan program for small businesses. It's term loans used for expansion, renovation. There's new construction, leasehold improvements, acquiring land, equipment, fixtures, working capital, basically, anything you use traditional debt for, but just as a qualified small business. Terms and conditions of these loans, such as the guarantee percentage and the loan amount, vary by the type of loan and some of the various other conditions and covenants that go into place there. The other two programs are the 504 and the Microloan. The 504 program is the economic development loan program that provides approved small businesses with long-term fixed rate financing, primarily used to acquire fixed assets for expansion or modernization. They're made through CDCs, these certified development companies. They're basically the SBA's community-based partners, different lenders and similar, type companies. And then the microloan is basically extremely small loans under $50,000 for small businesses for working capital purposes, inventory, supplies, furniture, M&E, machinery and equipment. But the key here is that they can't be used to purchase real estate and also can't be used to refinance other debts. The main modification for these programs in this most recent legislation is that this debt relief that was a part of the original CARES Act package is being essentially re-implemented here on a somewhat similar basis. They're doing the debt relief payments on P&I for existing loans starting in February 2021, so next month, for 3 months, and they'll be capped at $9,000 per month per borrower. And then after the 3-month period, borrowers considered to be underserved, so smallest or hardest hit by the pandemic, will receive an additional 5 months of debt relief, so P&I payments with the same caps and limitations. And then those are for existing loans. So any borrowers who had qualifying loans prior to the enactment of the CARES Act, and for any SBA loans, new loans obtained from February 1st through September of this year, there's also going to be debt relief applicable to those loans for the first 6 months of the loan after they receive it after the origination, with the same caps as on the existing loans, but for a longer period of time, potentially, other than these other smallest and hardest hit businesses. Next slide, please.
So a few additional details about the 7A 504 microloan program for incentives and enhancements that were included in fourth relief. There's about $2 billion that were allocated for the 7A 504 and microloan programs, including two, understanding that it increases the loan guarantee of up to 90% and offers reduced or no fees for participants in the 7A program. Similarly, for the 504 loan program, fees are eliminated. And then when you look at microloans too, the aggregate loan limit for microloans, it's for intermediaries, was increased too. So some additional incentives if you're looking at other loan programs under SBA. Next slide. So let's shift away from some of the financial relief that's provided and look at other relief, particularly through the tax incentives. So as we just were talking about with the Paycheck Protection Program, that was directly addressed in this fourth round of relief. And in particular, too, purposefully, given that the Department of Treasury previously had blocked deductions of expenses that were taken, forgivable expenses under the PPP. And so with that, Congress clarified that any forgiven PPP loans will not be included in taxable income. But two is that it clarified that deductions are allowed for expenses paid with proceeds of a forgiven PPP loan. And in fact, Treasury just came out with additional information on that today and to affirm that and provide additional clarification. So then we also look to some additional incentives, the extension of the paid leave credit. If you recall, under the Families First Coronavirus Response Act, there was mandatory paid and leave that was required, but they looked to offset that through tax credits. The fourth bill extends the refundable payroll tax credits through March 31st of this year. And then we look at the charitable giving incentives. Before the CARES Act, charitable contributions only were able to be deducted if taxpayers itemized deductions. Well, under the CARES Act, you could take charitable deductions of up to $300 for cash contributions made in 2020 to certain qualifying organizations. So talking about religious, charitable, educational, scientific organizations. This above the line deduction was extended for 1 year through the end of 21. Additionally, too, the bill extended through the end of 21 the increased limits of deductible charitable contributions for companies who itemized. And so for cash contributions for companies, there was previously able to deduct 10% of taxable income. Now it's looking at able to deduct up to 25% of that taxable income. Vince, I'll hand it over to you to speak to the employee retention tax credit.
Sure. Thanks, Sarah. So this was the employee retention tax credit modifications were fairly significant for several businesses, I would say, especially those who received PPP loans the first time around and had to choose between the employee retention tax credit and receiving a PPP loan and weighing the balance there last year when these originally came out. So there were several modifications made. I think the main one is there were technical modifications that allow you to, obtain credits and different things or increase credits this year. But they're now allowing employers who obtained PPP loans last year to claim the employee retention tax credit on eligible wages not used to support your PPP loan forgiveness. So essentially there's no double counting. You can't use, if you claim or you applied for forgiveness based on certain wages that you used your PPP loan on, you can't also then turn around and claim the employee retention tax credit for those wages. But anything else in 2020, this is retroactive, this modification to the enactment of the CARES Act. So for the 2020 calendar year, for that period, any employer can now claim that credit just as long as they're not double counting those wages. So there'll be a little bit of background, calculations and siphoning things off that will need to be done, but it's very important that, businesses and employers can take advantage of both of these, this tax credit and the PPP loan if they already received it last year. With the levels that were in place last year. So some of the modifications are for the credit to be applied in the first half of 2021, they increased the credit rate from 50 to 70%, raised the limit on per employee creditable wages from $10,000 for the year to $10,000 for each quarter, expand the eligibility for the credit by reducing the required year-over-year decline in gross receipts from 50% to now 20%. And then modified the threshold for treatment as a large employer by increasing the 100 employee delineation for determining the relevant qualified wage base to employers with 500 or fewer employees. So all very important changes, but those changes only apply for 2021. or payments made for 2021. But there is, again, the ability to claim this credit for 2020, even if you did receive a PPP loan now, just at those rates from last year and subject to those limitations from last year. And then on this, the relief for individuals with FSA, it allows, Sarah, I don't know if you want to cover this, it allows the individuals to carry over essentially any unused health and dependent care FSA benefits from 2020 into the 2021 plan year, along with other FSA plan flexibilities.
Mm-hmm.
We can go to the next slide. So, and then another, I don't know how applicable this would be for businesses in general, but just another big piece of the act is the direct economic relief for individuals. Obviously the direct payments, which was a subject of much debate, or at least much scrutiny in the last, 7 days or so before President Trump actually signed this into law, because he obviously wanted larger payments. And I think several other individuals also wanted larger payments, relatively in that $2,000 range. But what they got is the $600 payments per individual, subject to the similar restrictions or limitations. Individuals making up to $75,000 a year, $1,200 for couples making up to $150,000 per year, plus the child dependent payments. And then on the unemployment insurance front, there were also modifications, including the additional $300 per week, enhanced federal unemployment insurance bump. The $300 per week goes for 10 weeks from the 26th of December through March 14th. The PUA program extends the PUA. The PUA provides additional weeks of federally funded employment benefits to eligible individuals who became unemployed as a result of the pandemic and are either self-employed, do not have sufficient work history to be eligible for a claim, or have exhausted other forms of unemployment insurance benefits. The bill increases the maximum number of weeks an individual may claim benefits from 38 to 50 weeks. And then this PEUC program, the bill also extends that, providing additional weeks of federally funded benefits to workers who've exhausted their regular state unemployment benefits, and it also increases the weeks of PEUC benefits an individual may claim from 13 to 24. So some significant, well, somewhat significant, some may debate it, for individuals as well on the unemployment insurance and the direct payment front. Next slide.
And then we'll shed a little bit more light on some of the other relief provisions too that were included in the bill. And just to touch on something that Vince was talking about too, related to the direct payments and the unemployment insurance. Another consideration for why we included it in here, because under the CARES Act too, if you recall, the unemployment benefits were extraordinary. In turn, where we had worked with a lot of businesses that were concerned that it incentivized some of their workforce to continue to remain on unemployment rather than to return to work. And so this is where Congress came into play after extending some of the unemployment benefits after the CARES Act had expired, and then through the expiration on December 26th to still provide some additional benefit, but not to the extent where we were under the CARES Act and with concerns from industry on that too. But now looking towards some of the additional industry-specific relief and funding that was provided. We'll just take a look here at healthcare, transportation, and education. But as I mentioned at the beginning of this presentation, there's additional provisions in there, for instance, on rental assistance, agriculture, et cetera. And to provide a little bit more details beyond this funding that we will speak to on this slide, also understand that a lot of this funding is going to the federal government. Some of it in turn is going to the states and localities. And where this funding provides opportunities for companies and industries in these sectors to actually be recipients of additional funds and partnerships with the federal government or with state governments. So for instance, on healthcare, we understand this is going to remain a top priority on COVID for both the incoming Biden administration, as well as for states and localities. In particular, where a lot of focus and funding is dedicated to vaccine development as well as to the distributions. And so that's why you see about 22 billion for testing, contract tracing and surveillance, about 19 billion for BARDA. A lot of companies have been involved there as far as being in partnership with BARDA if they're in the healthcare space to be recipients of that funding. We also look to, for instance, the 3.25 billion for the strategic national stockpile. These are things, for instance, for a lot of the supplies where we were in great shortage and the federal government was looking to purchase them. For instance, think about at the beginning of the COVID-19, their large purchase of a lot of PPE. And then also to understand that about 8.7 billion is going to the CDC, with about half of that going to states and localities. So while states and localities didn't receive additional direct funding through this fourth relief bill, they are going to be recipients to some dedicated funding for some of these specific uses under healthcare, as well as we'll see under education. On transportation, understand that there's a funding provided for airports, rail, highways, transit. This includes an extension of the Aviation Workers Payroll Support Program. And this program would be equivalent to supporting the aviation workforce, like you would see with the intention where the PPP was, and intending to support overall the workforce for the private sector too. We have a large amount of funding, 7 billion worth, going to the expansion of broadband that would be used for purposes of telehealth, also expand the coverage to minority communities and to underserved. And then we also look to, for instance, additional provisions that were included in there that were related to consumer product provisions, specifically related to where we saw a lot of actions come out of FTC related to how companies were marketing their products and how their products would respond to COVID-19. So additional dollars were provided there to help fight those scams. When we shift then over to education, we saw a large amount of funding that was provided over the past couple bills for the education sector. In particular, we have about overall 89.1 billion that would be included in what's called the Education Stabilization Fund. This supports some of the existing programs that were stood up before, with additional funding going to the governor's emergency education relief fund. And it can support early education, it can support elementary and secondary, as well as higher ed, and be used for a variety of purposes. Then we have a bucket that's dedicated to elementary and secondary school emergency relief. And a lot of this goes down to, again, the states of what they receive, and from there, how the states are allocating it out to specific providers of products and services. And then we have another bucket of funding of 22.7 going to the higher education emergency relief, and largely this is to support campuses and students throughout COVID as well. So just a snapshot of some additional relief provisions, but also opportunities that could come from it for businesses. Next slide. And so really, we've come to the conclusion of our presentation. We'd be happy, Steve, to be able to answer any questions that the audience or MMAC may have for us.
Well, great. Thank you so much, Sarah and Vince. A real simple bill, so I imagine there won't be many questions. Thanks for plowing through a lot of information there. I do have a number of questions here that have popped up, and so we'll get through as many of them as we can. First, one that hopefully will be quicker and simple is the definition of live venues under the live venue, the 15 billion for live venues. How is that defined? How does that deal with, for instance, cabarets, bars that have live music? Are they in the live music category, or are they shut out on that?
Great question. I know that there's going to be a lot of different industries that are, or businesses that are looking to see whether they qualify under this new grant or not. Right now, we don't have specific clarification on that, Steve, but we do anticipate with SBA standing up this grant program that they will specify what exactly it means to be eligible for the live venue operators. But those that have been spoken to so far that we know would be included in that, for instance, that they've used for examples would be for live performing arts organizations, museums, cultural institutions. So for the specific example that you provided, it's rather unclear. The thing that I would also offer, though, is understanding for that specific example, any additional dollars they may be able to receive if they come under the NAICS code of 72 for that 3.5 times in funding under the PPP rather than the traditional 2.5 times of payroll expenses. So that's an additional incentive they should be looking at if they don't fall under the shuttered venue operators.
Great, thank you. Now, a question that's particularly pertinent to an organization like MMAC, which is a 501c6, but a question on the mechanics on the PPP with C6s this round. Can C6's PPP be applied retroactively for the period covered in the first round of the PPP? So if I'm understanding this question correctly, when you're calculating the size of your request, can you calculate your loss or your payroll and your rent and utilities and that from roughly 2020 in the PPP that you're now eligible to apply for? Can you go backward retroactively to calculate your amount, even though at the time you were incurring that amount, you weren't eligible?
Vince, did you want to take that or do you want me to?
Up to you, Sarah. I think the answer, and I'm not 100% on this, but I do think, I don't think that you'd be able to go back to 2020. I mean, I think you would have to use whatever, I guess, the parameters are for, calculating that payroll amount within the act. I'm just trying to look quickly, sorry.
Yeah,
I think it would be one prior year. So you're asking if you can essentially use that one prior year from the date in 2020 as opposed to the date, I guess, currently.
Right.
As a look back. Yeah, I mean, I guess we'd have to wait for more guidance to come out, but my thought would be no. I think it would be, you'd have to use the most recent, prior 12 months or calendar year.
Okay.
Yeah. And Steve, that's something too, we'll be understanding as SBA releases their guidance on this anytime now, more of that. And this is just a demonstration too, for instance, what we experienced in the CARES Act. The time frame for which was included in the statute for which you were going to be applying, the one prior year or the calendar year was different from what actually SBA allowed. They actually expanded what they were to allow as far as including 2019 or the average of the 12 months prior from when you were applying. So we may see some flexibilities related to that too, of what you may be able to look at for eligibility for that calculating your monthly payroll cost.
A similar eligibility question on the quarter, the 25% reduction in gross receipts over quarter. Can you use the same quarter for the second round as you used for the first round to demonstrate your eligibility? This would be an organization that was available in the first round and available now for a second round. In demonstrating eligibility, could they, say Q2 of 19 versus Q2 20 is what they based their round one PPP on. When determining eligibility for round two, would they have to pick a different quarter, comparable quarter, or would they still be eligible based on that?
No, I think they, go ahead, Sarah.
No, there's nothing that would preclude that if you're going to apply for both your first and second round to use, and the demonstration, the 25% hits the reduction in revenues. For this second round of PPP, it just specifically states as far as using the same quarter in 2020 compared to the same quarter that of 2019. So really that's the basis for comparison there. But if there's nothing to say right now as far as having to use some other data other than that.
Yeah, I would agree with that.
Vince, this one is something you talked about, the double counting and you can use both PPP and ERTC. A question on the understanding of that. Since eligibility for forgiveness still has the 60-40 rule, if a business is trying to maximize using both of these things and you can't double count, are you suggesting, and again, not giving advice on this, but could it work this way that you use the payroll that gets you up to 60% for your PPP, and then you take ERTC for any remaining payroll? Can you do that? And that wouldn't be double counting, but that would be maximizing what you're getting off of ERTC?
Yeah, that's right. I think that is right. The tricky thing is for those employers who have already applied for forgiveness based on different calculations they've made or reports that they've sent in, there may not be that flexibility. So, it'll probably only apply to those that still haven't submitted their forgiveness application for their PPP loan from last year. But yeah, I don't see why not. As long as you have enough other expenses to, fill in that gap, you could, essentially not use as many or use as much in the payroll category and, use more in the other expenses category to try to maximize both benefits essentially.
A question on forgiveness. In the first round, and correct me if I'm wrong on this, there was kind of a presumptive forgiveness up to a certain amount. I think it was it 150,000? You were just assumed that you were. Is there something like that in the second round as well, or is that something that'll be determined in the rules as they go forward?
So the forgiveness process for the first round will be identical to what we expect it will be for the second round as well. So what we're seeing though with this fourth package relief, that there was just improvements that were made to it. So Steve, you referred to one of them, that there's a streamlined process that's provided for loans of under $150,000. So you'll see the identical processes unless they were to change under future legislation. Also for your second round when you work with your lender then.
Okay. I have another question on ERTC. I'll read it here. Prospectively, will costs used for ERTC not be able to be used for PPP? Will there be an adjustment on either the 941 for ERTC on the PPP loan or loan forgiveness applications for costs used for the other programs? Some of this I think you covered, but I don't think we got to all of it in previous answer.
Sure. A little bit to untangle there. I think some of it has been covered. As far as the costs or, amending, I guess, the 941s or figuring all that out, there's just going to need to be a lot of background calculations and different sorting out that's going to need to be done. But yeah, as long as you haven't submitted your forgiveness application, with respect to being flexible and trying to figure different scenarios out as to what's the best benefit are still possible at this point. I don't know if that answered the question specifically, but
Here's another one that I think we got at, but I just want to make sure in case we didn't. Where is it here? I'm trying to find it on my sheet. For ERTC, can the same expenses be used that were used for PPP? If no, how does retroactive ERTC affect a PPP loan already forgiven?
So if the loan's already been forgiven and those payroll costs were included in that forgiveness application, they would not, you could not.
Now they're
double count.
ineligible on the retroactive.
Right. Yep. So you could use whatever you didn't use for the PPP on the ERTC, but you can't use both. Essentially, that's the long and short of it. There won't be any double counting that'll be able to be done. I think, Steve, as you mentioned earlier, the big thing is if you haven't submitted your application, haven't received forgiveness, obviously, trying to come up with some type of flexible, and who knows, something in the guidance may say you can't do that, but if you have the other expenses there, trying to reduce your payroll costs, even though it's over the 60% threshold, to try to get more expenses in to be able to claim the credit for a larger amount is probably the one main option that employers are going to have.
And just to be clear, something I think I heard you say, health insurance or insurance premiums are classified as payroll? Or
That's
are
right.
qualifying as payroll? That figures into that accounting? Okay.
Right.
Something for you, Sarah, that came in on the other programs, the education funding. Is that all just for public schools, or is there any of that for private or religious, or here in Milwaukee, like choice schools, or is it just district schools?
There is a portion of it that's accounted for private schools as well. And you all will recall that was a big topic of debate under Secretary DeVos. That's been one of her chief priorities, was being able to support private and charter schools and also receiving this funding. So there is a portion of that funding that is allowed to be used for non-public schools.
And how will that be administered? Is that something that the schools themselves will apply directly to the feds, or is that something that the state DPI or the administration will go out and set the state rules on?
So for a lot of these buckets of funds for the education sector, they go from federal to state. And so work with DPI as far as if they're the recipients of those funds on how they're going to be allocating them. And there's going to be specific requirements for some of these buckets, like there were under the CARES Act, that they have to follow as far as portions that can be kept for the state education agency versus the local education agencies.
One quick question on EIDL here, as we're getting close to the end. The first round of the EIDL program, there was the $10,000 automatically forgiven or automatically granted. Is there going to be another, for lack of a better term, free 10,000 again this round on EIDL, or is that not a feature of the second package here?
No, it is a feature of the second package. There's additional advances that have been provided. It included about $20 billion in the EIDL advanced grants, with the specific additional dollars that are provided for those that are in low income communities. So that continues to be a big advantage for the EIDL program. Despite that, the actual going through the program itself, we understand has been a challenge for some businesses, as SBA has tried to move through it as quickly as possible. We know that there's been some hurdles there in companies receiving information back from SBA. But those grants, essentially what we've from the businesses that we've worked with, you apply for the grant and you receive that $10,000, and it now doesn't have to be deducted from what can be forgiven under the PPP as well.
And I guess just to clarify, so if you applied for EIDL for the 10 grand earlier this year, on the first roll of it, and got the $10,000 grant and didn't take anything else, anything additional in a loan, and you just got the $10,000 grant, will you be able to do that? I know it won't count against your PPP, but will you be able to apply again for another $10,000 grant under this next round of EIDL?
That's what it appears to be. That's what's intended, Steve. But we'll see as SBA moves forward with it, what it looks like, and understanding that these dollars have been moving through very quickly. But the EI deal, that program has been expanded to be open through the end of the year, or while funds remain. So yes, I would work with SBA, revisit SBA as they get everything stood up again, and as this funding is moving through, to see how you can maximize and additional dollars for grants if you haven't yet received it, or if you have received it, being able to see if there's additional, depending on what level you received the first time, if you can receive anything else.
Great. And maybe just one last question before we run out of time. You noted that PPP borrowers who receive $2 million will have to fill out a necessity questionnaire. What should we look out for as we complete that questionnaire? Any landmines there that people need to be aware of?
Sure. Yeah, there's several landmines there. And that questionnaire has been subject of much scrutiny as well, whether or not, it's essentially the SBA's audit procedure, whether or not they're asking the right questions, essentially it's trying to get at what was the borrower's necessity for obtaining a PPP loan. They want to know that if you obtained a larger PPP loan, you actually needed it. Some of the questions they ask are, what was your revenue in 2019, quarter two 2019, as opposed to quarter two 2018, or 2019 versus 2020, things like revenue. Did you have to implement any additional costs because of COVID? Were you prevented from operating? It's really getting to the business activity, and then also your liquidity. So it asks for bank statements, things like that, just to see what your cash position was as well, to see what other resources you had available, as opposed to obtaining the loan. What comes of it next, I guess we're still waiting to see. But I think the key is if you do have to complete a questionnaire, be thorough enough, be truthful, complete it, get it done in a timely manner. But also, you don't need to overdo it or over disclose anything. I just be truthful enough and try to kind of put your best foot forward as to what your need was, given the facts that are there.
Great. Well, we are out of time. This hour has gone quickly. I appreciate Vince and Sarah, your expertise. We will be posting this online. So folks who want to review some of the things or look at that deck again, we'll have that up. But again, I want to thank everybody for joining us, and particularly thank Michael Best Strategies and Vince and Sarah for helping us unpack a pretty complicated bill, but a bill that could have a big impact on the success and even the survivability of a lot of our member businesses. So thanks again, and everybody be safe. Have a great day.
Absolutely. Thanks, Steve.
Thank you.